Good afternoon. This is Jim Colburn of Commodity Research Group. I'm here with Andy Lebow, also of Commodity Research Group, and we're here to talk about energy markets. To learn more about us, you can check out our website, commodityresearchgroup.com, where we post our podcasts and blog. We would like to thank our friends at EKT Interactive Oil and Gas Training for hosting this podcast. Check out their newsletters, podcasts, and learning modules at ektinteractive.com. This podcast should be construed as market commentary, merely observing economic, political, and market conditions, and is not intended to refer to or endorse any particular trading system, strategy, or recommendation. We are not responsible for trading decisions taken by anyone. Information is not guaranteed to be accurate. This is not an offer to buy or sell any derivative. Today is March 28th. And Andy, it's been a little while since we had our last podcast. I think we should start with the Russian oil in the marketplace. What do you think?
That's probably a good place to start. I think our last podcast was the day before the invasion. So right. A lot has happened since the invasion, and I'm sure our listeners have been following closely on many fronts, including the oil front. Oil prices have traded, it's unbelievable, in the last 4 or 5 weeks has traded between 92 to 130. Volatility in the market is just so volatile. Jim, what was the high on vol in March?
In the front month, the implied volatility settled over 100%. That was on the March 7th day. You know, when we had that, it was the high of the move, but we settled on the lows. So it probably traded even higher than that. It was interesting that day. The second month had made its high the Friday previous. So on that big day up, we did see eventually a lot of profit taking in the call side of the market. But yeah, it got over 100%. Compare that to Gulf War I, where the second nearby was over 120%. So that was a long time ago, different situation. But yeah, it's still around 75% for the first 2 months now. Those are high numbers when you consider how high prices are. It's hard to maintain that vol, unless there's a war going on, which is where we are.
Yeah, which is where we are. And I think we're recording this on March 28th, and today was a good point to look at, because on Friday night the market looked so bullish, closed on the highs. A lot of concern about the Houthi attacks on the Saudis. Obviously on a lot of supply fronts, which we will go into in detail. And, it looked as though Monday we'd be a lot higher. And we opened $5-6 lower. We get down $8. And, completely, if I was a betting man, I would not be betting on the market down $8 today. But I think it's part and parcel of the what we're seeing in trade, and how difficult it is to trade this market, Jim.
Yeah,
in every way, it's very difficult.
It's quite untradeable. But Andy, a lot of I guess the IEA and a lot of other people are looking at 3 million barrels per day of Russian oil that will be taken off the market. Can you talk about that number and what you think about it and where you come out?
Yeah, one of the reasons why it's has become so difficult to trade is these supply and demand numbers are almost impossible to track. There's a lot of uncertainty on both sides. Jim, that my whole career has been spent as a barrel counter. And at Commodity Research Group, we really pride ourselves on our numbers, and I think I think we've been pretty good both at, throughout both of our careers in trying to barrel count.
I,
And
I would just say, Andy, I would just say my career has been spent, period. But go ahead. Sorry.
you're still going.
Yeah, still going.
You, we may be wasting assets, but I think we're still assets.
We're we're
But
we're we're
in any
decent of
event,
we're decent of some of your options.
yeah,
Yes.
yeah, yeah. We're decent. So we haven't expired yet.
No.
But getting back to the numbers, yeah, the IEA threw 3 million barrels a day out. I think they're high. The numbers that we've been able to we've been able to work out for April is, I think it's closer to 2.3 to 2.4 million barrels a day. And the IEA said from April going forward, because in March, a lot of the supply coming out of Russia was still coming because they were a lot of it was contracted barrels. It's not to say that none of it had been disrupted, but there was still a good amount of supply coming out. So for April, we're working at around 2.3 to 2.5, and then as we head into May and June, moving into closer to 2 million barrels a day of disrupted, and that's both on crude and refined products. What has to happen here is the flows have to normalize somehow, and we think they will, but we think it's going to be, later in the, sometime into the third and into the fourth quarter, and supplies will probably normalize at a loss for Russia of about 1.5 million barrels a day. Almost certainly, Asia is going to pick up some extra supply. It looks like, unless the atrocities grow greater than they already have been, it looks like the EU and Germany in particular is going to continue to take barrels out of the Friendship Pipeline, the Druzhba pipeline, but I still can't. I still call it the Friendship Pipeline. So that oil is going to flow. Seaborne oil is going to be disrupted, no question. There's as we know, there's a de facto embargo and an official embargo from the United States and from the UK. So, working all this out is really difficult. You could look at where the premiums and the discounts are on the physical market and try to figure it out. But that's basically what our best guesses are. I think that, as we head into the third, some of these barrels will probably go into storage. What's problematic for the Russians, of course, is as their exports are reduced, their production ultimately, storage will get filled, and their production is ultimately is going to have to go down. And they're just now recovering from the cuts they made in 2020 after the price collapse. So I think the one thing the Russians really don't want to do is see their production go down, but I think that's going to be a inevitable event.
So Andy, that's you're talking about, say, 1.5 down the road, say 2.5 more in April,
Right.
and you're talking about a total market of about 100 million ish.
Right.
So how do you make up those barrels? Like
It's certainly not impossible in the intermediate term. Short term, it's going to be tough making that big of a supply up. But in the intermediate term, I do expect that there's going to be another release out of the reserves, and the last release was 60. The administration is indicating it could be even higher, but let's say another 60 million barrels are released. I know that some of the banks have been poo-pooing that, but 60 million barrels over a quarter or over 4 months, that's a decent supply number. So there's certainly that. And let's look at, and I think that non-OPEC in the second quarter will probably eke out, it might be able, again, second quarter might be able to eke out another zero point 0.3 to maybe 500,000 barrels a day extra. And finally, there's a demand side, Jim.
Hmm.
Certainly, it looks as though as we head later into the second and third quarter, Russia will be in a recession. Ukraine, unfortunately, has lost its demand, and China, as we know as of today, they've locked down Shanghai for 8 days, so we are going to lose demand out of China. And finally, a lot of economists at the banks, and I think we'll probably get some new things out of the IMF coming out of the IMF, OECD, and I suspect they're going to reduce global growth. So we're gonna lose some demand just out of that. So all told, I think you're looking at maybe 1.5 million being reduced, being made up sometime later in the second quarter, and possibly into the third quarter. Again, we make up another 1.5 million. U.S. production is going to grow. So actually, you look at these balances going forward into the second half, they're not so awful. In fact, they're pretty well balanced,
Balanced
which is,
or
yeah, balanced or surplus. We could, and let's not forget the Iranian deal.
I was going to say
Uh,
you didn't mention Iran and you didn't even mention OPEC. So
yeah, OPEC is also, yeah, these are also all in my own numbers, right? OPEC is going to, is going to continue to increase production. I think that was always sort of baked in to the numbers, a
right,
300,000 barrel a day increase from OPEC. And then in May, some of the allocations are going to increase based on based on the deal they made last year. So we could see even more out of OPEC than than these numbers assume. And talking about OPEC, the Iranian deal is still being negotiated. All the diplomats are indicating that it is close, but they still have some big stumbling blocks. And whether those are geopolitical, well, part of it is geopolitical because the Iranians want the US to remove the Revolutionary Guard from their list of terrorists. And, the US is balking at that. So, I think the deal is going to get done. It's just a matter of when. And looking at our, balances, given our best guesses for OPEC, no, no increase, no Iran deal for now. But our balances are actually showing some surpluses, Jim, right across the board.
so
Each for the rest of the year, which is kind of surprising when you work them out.
OPEC is looking at your numbers and they're saying,
Yeah, they probably are, but I've cut demand, I've
right,
cut non-OPEC,
right.
I've added some reserve barrels, and the numbers are what they are. But they could be off by a 500,000, 2 million.
Of course.
And that's a dilemma. They could be way off, and I think, and why it's so difficult to trade. Also, we have to note that inventories are really low. So all of this is coming on the backdrop of very low inventories. The IEA is saying that inventories are 300 million barrels below the 15 to 19, I think is the average. I mean, they're much too low, historically low, way too low,
Yeah.
whatever you want to call it.
I saw a
Um,
number where US inventories are 13% below normal for this time of year. Does that sound right?
yeah,
Yeah.
U.S. inventories are really low. Global inventories are really low. So I think the key, if we're wrong, and certainly we could be way wrong, as I said, on any single number. But the one thing that if you're wrong either way, and the market continues to be in deficit, we could get some rip roaring squeezes anywhere at any
Right.
time.
Right.
I mean, you and I have been through some unbelievable squeezes at Cushing, as we head into the summertime,
Yes.
April, May, June's, and I think that the key is that the market is we're in dislocation. There are flows changing and will continue to change. So when you're in this period of massive dislocation, you're gonna go from could go from shortage to surplus right back to shortage. There's unbelievably something happened where we shipped the middle distillates out of the Northeast to Europe. It went from us to them.
Yeah,
That
that's
never happens.
no.
It's unbelievable.
Yeah.
So,
Trade, yeah, the trade balances, I mean, trade patterns are shifting all over the
right.
place. Yeah.
So it means big dislocation. And we've seen big backwardation. I mean, we've seen massive backwardation, certainly on the Brent side, on the I mean, gas oil went hundreds of dollars backwardated. Heating oil, was close to 40 cents a gallon backwardated. So we've seen these already. And I think, as I've tried to explain here, that, the next 2 months look really, continue to be tight. It isn't going to be till, later in the second quarter, third quarter that, things have a chance to normalize. So, there's still going to be some, really interesting trading developments.
Yeah. I was looking at demand for diesel for farmers, and you would think the incentive is for them to plant fence row to fence row with the prices, but they're not sure this is going to happen in the U.S. But they talk about a shortage in fertilizer, and now diesel prices are through the roof. I'm just wondering, is that enough to reduce the amount of acreage planted? Again, I don't know what the budgets look like, or the incentives. Maybe farmers not only hedge their crops, but they hedge diesel as well. I don't know. Any
Maybe. I
yeah,
mean, I don't
any
remember. I don't remember us covering a lot of farmer accounts, Jim.
I know, but we did talk about planting and harvest demand. I mean,
Oh yeah, all the time.
all the
Well, it
time.
wasn't the farm. I mean, it wasn't the farmer accounts. I mean, it was the dealer accounts,
Right.
and
Right.
yeah, those we did have. So yeah, I don't. Yeah, it's certainly possible that it may impact demand, and then the question on refined products is what the elasticity is really all about. Particularly
Right.
for gasoline.
Right. Could you talk about producer response in the US? I mean, you would think, now's the time they're going to be growing like crazy. And I guess there's some constraints to that.
Well, they say there are constraints to that, but there's been some of the some of the larger producers have been belly aching about labor crews, getting enough labor crews and sand, and and the inputs are, their input, because of inflation, their input prices are way up. But my goodness, I mean, you
Yeah.
look at the prices and even the back of the curve. I think
Yeah.
there's plenty of incentive for them to increase production. And we've been saying even before the invasion that we thought the EIA numbers were too low, and that production was going to be higher than what they said. I mean, currently production is 11.6, let's say. They have us. They have us getting up to around 12 million in June or July. So that's pretty healthy. I mean, that's 400,000 barrels a day by mid-year. And then by the end of the year, November and December, they've got us up to 12.5, 12.6. So that's a million barrels a day by the end of the year.
Okay.
I think I think we're going to do better than that. I think it's going to be another 2 or 300 better. I also think, Canada's talking about increased production. I mean, all of non-OPEC, if you're a producer, this is your environment, to try to increase production despite the inflation.
Right.
You've got some massive margins here.
Yeah, it kind of, in a way, it looks like we're settling into the old oil cycle where, prices run up, or there's some, either OPEC's keeping oil off the market, or there's some shock to the system. Prices run up, they stay up for a while. We conserve, using it, and then there's this massive incentive for producers to produce more, and then we start heading on the downside. Now that takes, you can think that through in a couple of minutes, but it takes a long time for all that to happen. So do you think that's kind of what what we're seeing unfold right now?
Yeah, we've lived it. I mean, I think,
Yeah.
it's hard to say not, because oil since the 1860s, when we have pricing, it's highly cyclical. Just this last 2 years, we've seen minus 40, minus 40 to plus 130. Now,
Yeah.
those are obviously extreme parts of any type of cycle,
Right.
but sure, we'll probably be setting up for some weakness ahead. But if we go back 2 years from now, you had a lot of producers worrying about existential risk, and a lot
Yeah.
went under, unfortunately.
Right. Yeah. Again, you
So
you can't
yeah,
you can't flick a switch and say, okay, oil prices are back. Let's just start producing like crazy again. It's there's still what would you call it, PTSD from 2020, where that they're still cautious.
right. But you can, the one good thing about shale is the cycle's pretty fast to from the time you put it, you put
Yep.
the shovel in the ground,
Yeah.
and it's quick.
Well,
It's months. It's shorter than, some could be even shorter than months. It's not like a longer term project where
yep. And
you really
Andy, I recall it's a good points. I recall just a few years ago how the shale oil production was going to dampen volatility in the oil markets because they could react so quickly. So shut down when the prices get low and start up when the prices get high. And I just kind of Googled that and found some interesting studies and interesting titles of studies about how oil volatility is going away. And I think you and I have been through enough cycles, as we just mentioned, that we wouldn't sell straddles and strangles on those studies, based on those studies.
no,
No, and we kind of lean
no,
towards
that
no,
would be a no.
no, and
Um,
the other interesting thing we've seen, if you think about hedging 101, you sell forward. If the price goes down, you're covered. If it goes higher, you already contracted at a price lower than the market, but you're going to get that higher price in the cash market. So it's an offset. Only that's nice in theory, but when you go out, say, a year, and you have to sell crude forward, and the price shoots up, you've got major margin calls on that position, and you're not going to get that cash offset for another year. So we've seen this happen with power companies in Europe, even pre-war, and I think some of the oil companies, I would guess, are looking at, in this rally, are looking more at buying puts as a strategy rather than selling futures, because of the the known. You buy a put, you know exactly how much you're paying for it, no matter what happens to the price, and you get downside protection. Not as good as protection as a futures contract, but you don't have to worry about making margin calls. So I think when I look at the pattern in options world, you know, the market seemed to be prepared, overall in general for a rally in price. We had talked about all the bullish option flow we'd been seeing since the first quarter of last year, 2021, especially with those D100 calls. And when this war broke out and we got a spike, you saw heavy volume in calls. But on that March 7th day, you actually saw open interest go down in calls. If you take Brent and WTI, there was 394,000 calls trading. Open interest went down by 9,000. And on the put side, there was 192,000, so a lot less, and 41,000 new contracts opened up. So you could kind of see that a market that was prepared for fundamental reasons for the market to go up, and then they got the spike and they say, okay, we'll take that, and they got out. And at the same time, I think producers are seeing these really nice prices out on a curve, and they want to protect their expansion plans. And so instead of selling futures way out there, they're buying puts. So again, I'm looking at it from a macro, bird's eye view, not the. I'm sure there's individual stories that are opposite of that, but that's in general what it looks like.
And what about the speculators, Jim? The large funds. You think that they're actively participating right now? You think that they just decided to shut it down?
Well, we know, as you know, we have been when we worked at ED&F Man, we were, one of the biggest funds around, starting with the Mint Fund, but later on as well. And a lot of those funds had volatility kickers that would kick them out of the market. So didn't matter which way price was going, but when the markets got too volatile, they would kick out. And one of the reasons for that was some of them felt their edge was in the ability to manage risk. So it was this uncorrelated asset idea where they're flipping coins, buy and sell signals in many, many different markets. And so they're if they're uncorrelated, if they keep that uncorrelation assumption intact, then they can manage risk better. But when you get these hyper volatility markets, all that goes away. And so some of them will tend to move out. Having said that, we did see, say, first quarter of last year, an accumulation of a huge position in the D22 calls, the 100 calls. Open interest got over 70,000 at its peak, I believe, and now it's down to 49. So that could have been just one speculator, but that's still the number one open interest contract. I'm pretty sure it's a speculator, at least one speculator, and there's been some liquidation in that, but not a lot. I mean, there's still a lot of open interest out there. So basically, to answer your question, I think the speculators have backed out. I just put a LinkedIn story. It was a Bloomberg story. I put it up on LinkedIn where they quote our friend Ilya, who said the only people trading now are the ones that have to trade. And and he said that's adding to the volatility. And I think that's right. And
I think that's right too. Going back to the initial point that we were talking about, you look like a day like today. You're down $8. It's not out of nowhere. I mean, there were developments, but nevertheless, quite unexpected after Friday's close.
Right, and I think on days like that, Andy, when you were on a desk and the press would call, you were careful that, like, if the market was down $5, rather you can try to explain why it was down $5, but you didn't want to get too crazy, because by the end of the day it could have been unchanged or heading higher. So it was kind of like, okay, we can find some reasons, but is that really what's going on? But sometimes it's just crazy volatility, and we don't know.
Yeah, and could the market be up $8 tomorrow? Yeah,
Certainly.
it certainly could. I mean,
Yeah.
as we mentioned, we're looking at a $90 to $130 range over the last month. Now, as you said, Jim, that's unsustainable, and
Yeah.
these vols are high. I mean, the market almost by nature has to, does have to calm down, or doesn't. I mean, I guess, but that would be I could, yeah. I mean, things would really have to worsen or something change.
Yeah, I
I
agree.
would think.
Yeah. I think markets, despite all the algos, I think they're still run by people, and people get tired. And we're seeing that
Right.
in options volume. It's, some of the days that we've had recently, like post, last week or so, you would say, "Oh, is this a day before a holiday?" They're really low volume days, and I think people are just saying, I don't know what to do here. My positions are flat, so I don't have to do anything here. So I'm not going to do anything here. And yeah, so but again,
And we see that in the commitment of traders. Those
right?
positions have really been trimmed, and I think there was I think John Kemp at Reuters had written an article that open interest in petroleum, all the petroleum contracts, was the lowest since 2015.
Yeah,
And you would think, oh wow, oil's really hot, that open interest would be soaring, and
no,
it's been quite the opposite.
yeah. I think John Kemp writes for Reuters, and he puts out an excellent summary of what's going on in the commitment of traders, and I look for that often, and just to give him a shout out.
Yeah,
But
he does.
I-
Yeah, he does a good job.
so I guess the next question is, Andy, is where do we go from here? So we talked about through COVID how hard it was to get a handle on demand numbers, and we still have COVID out there with China, and now we have this Russian, basically how much Russian oil is going to be taken off the market. What is there a number out there that you do have confidence in,
On a price basis,
or just give me a price, give me
to be perfectly honest, no. I mean, I look at the balances, and I would think, some of the war premium or volatility premium should come out of it, and the market should start moving lower. Under, maybe even under 100. That could happen. But as I mentioned, there's so many. There's so many moving pieces that are so large that it's really, you could be wrong, everywhere.
right,
So what I think, however, is that there's certainly, could we make new highs? Yeah, we could make new highs, because as I mentioned, that with this dislocation over the continuing into April and then into May, there could be squeezes in certain products, certain futures. We already had one, sort of had one in heating oil and gas oil, and I'd really be, that would not surprise me to see something like that. It might be a short-term event, but globally, it could happen anywhere.
yeah. I listen. If you listen to these podcasts, how I am biased towards the buy side of options. I like being able to take a position in a commodity market with a known quantifiable risk. After Gulf War One, when the vol was up 120% on the second year buy, and the initial bombs dropped, and there was not a significant response from Iraq, sort of as it related to the Saudi oil fields. Volatility collapsed to about 85%, and we got our customers to sell options. We said this is, very little response. This is a market that hasn't, vol should be a lot lower. And so we got a few customers aggressively short, and they wrote it down to from 85 to about like 20-25%. So it was a huge year. I gave out a lot of option trade of the year awards that year. But the point is, I don't feel comfortable suggesting something like that here, because it's, there's not this one event type thing that's going to stop the volatility. It probably will dampen as we go on, but again, like you said, there's going to be very possible of these intermittent spikes along the way that's could be deadly, hazardous
Deadly, you know what, Jim?
to your
To you-
trading health.
Yeah, I
no.
mean, we're obviously, we're in the middle of a storm right now, and every now and then, if the storm is bad enough, you get these rogue waves that come in,
Right.
and amidst the other big waves,
Yeah.
So I think it's certainly possible that we see one of these rogue waves come into and be hard to predict exactly where it could be. I guess you could see it coming. You could see that wave come if you study hard enough, but
So,
you don't want to be on the wrong side of that.
but going forward, what would be the most bearish case you could make, say, going in, say 4 or 5 months from now? I mean, Iran's back on the market, economy slows down. What else? Quote unquote peace in Ukraine.
Yeah, peace. Sanctions are lifted, which I don't think is going to happen
Yeah.
anytime soon. I don't see that happening. I guess if sanctions are lifted and Iran is back on the market and OPEC is increasing production, the market could easily be under 70, maybe even under 60. But those are pretty extreme circumstances, Jim.
Yeah, because what I'm thinking of, Andy, is that a lot of times in these backwardated markets where you'll see people start to sell puts, say a few months out, and as long as the market stays backwardated, those puts are expiring worthless, and then they're I don't want to compare traders to rats, but it's like the rat experiment where they hit the lever, and a sugar cube comes out, and then within a short time they're banging on that lever to get all the sugar cubes out. You get a trade like that works 1 month, then it works 2 months, then it works 3 months, and people start loading up on selling puts into this backwardated market, and then all of a sudden it collapsed. So I'm just trying to get a sense of, what it might take to get something like that happen, but it's down the road.
Down the road.
Yeah.
So we will continue to have a lot to talk about over the rest of the year. I mean, another incredible year.
Another one. Yeah, we thought.
Unfolding.
Yeah, we thought we were getting back to normal barrel counting, but it's not.
Yeah, 21 got us a little bit back to normal after 20, which was also one for the books, and now we've got another one for the books 2 years later.
One last question for you, Andy, before we cut out, and that is, we do these podcasts oftentimes after the EIA monthly report, and then sometimes after the IEA and OPEC report. This time we're doing it a little earlier. They're out in a couple of weeks, I guess, or next week maybe. And what do you think what kind of revisions are they going to make to demand in their reports? Would you?
Well, the IEA already took demand down by 1 million barrels a day, which we're pretty close. Our numbers are pretty close to that.
And that's for this year?
OPEC didn't. Yeah, for the rest of the year. OPEC didn't, but they're going to have to. So I think we're going to see, OPEC make serious downward revisions, and probably the EIA, who did make some revisions on production, on non-OPEC production, because Russia's clearly not growing this year like everyone had expected.
Right.
So, they'll probably, I can't remember if they made downward revisions on demand or not, Jim, in the last report, but
yeah, I think they did.
Almost certainly they're going to have to.
They play catch up if they didn't.
Yeah, yeah.
Okay.
All right,
Yep. Go ahead,
I
Andy.
think we've got to
Wrap it up.
sum it up.
Yep.
We went through a lot, so the only thing I have to add is if you want to get a hold of me, it's Lebow, Alebow at commodityresearchgroup.com.
Yes, and we'll be posting this podcast on our website, commodityresearchgroup.com, and also Andy and I posted on our LinkedIn pages as well, which seems to get a lot of interest.
Yeah, look for us on LinkedIn.
Terrific. Thanks, Andy.
All right, Jim.